Okay, much better. So, Dr.
Yeah.
Saman, you may.
Yes. So can you go to the next slide? Yes. So this is going to be my presentation outline. So first of all, I would discuss what are the unique economic challenges that are being faced in a post-COVID-19 era, and what are the challenges which Islamic banks in particular face in this era, and then how they are responding to these challenges, and then what is some value addition which is presented and shown by Islamic banks in response through Islamic social finance and also fintech, Islamic fintech. And then we would also look at some of the empirical evidence of how Islamic banks are performing in the current times, and also how Islamic capital markets are performing in the current time. And then finally, we can have some question and answer session. So as we move to the next slide, we are going to see that what are the challenges to sustainability and economic stability which we are facing in a post-COVID-19 scenario. So if we look at the economic challenges, first of all, what we are seeing is that economies almost all over the world are facing low economic growth rate in the post-COVID-19 era. In the first year after COVID-19 broke out, definitely the economies were struggling, and then there was recovery in the next year. But then the Russia-Ukraine conflict and natural disasters and all the other things going on have put hold on the economic recovery, and it is now felt that the economic recovery was very fragile, was very weak, and it was short-lived. And again, we are facing the prospect of very low growth or even negative growth in some regions. And then governments also have pressure on making expenditure on relief efforts. So a lot of expenditure that was going on welfare services and on poverty reduction, that has now shifted towards COVID-19 relief efforts. And then there is high fiscal deficit faced by a lot of countries, and it leaves less resources for investment in environmental projects and projects which require consistent uh, budgeting and assistance. So projects relying on private funding are facing constraints as corporations and labor force see decline in incomes. So people are the main source of charitable giving. Individual to individual giving or individual to institutions giving is the major part of charitable giving uh, in the society. And as people are facing unemployment or decline in their incomes, and corporations are also struggling and closing down their businesses, so all of this has resulted in a halt in assistance being provided to many of the different projects, because a lot of resources are diverted to COVID-19 relief efforts. If we look at the sustainable development goals, we see that some of the positive gains which were achieved in the 2015 to 2019 era, some of these gains have also reversed. Like for instance, there is increased global poverty after COVID-19. So the SDG 1 of having zero poverty is being challenged, and some of the gains have been reversed, because now there is increase in poverty rather than going towards zero poverty or decrease in poverty. There is also rise in hunger, according to FAO organization of UN. There are 828 million empty plates in 2021. So we are nowhere near to ending hunger. Almost a billion people are facing the problem of hunger in the world. Uh, there have been a lot of deaths, and air pollution is also causing trouble. Uh, and then when it comes to schooling for many children, many people are out of school because of COVID-19, and a lot of the assistance that was going to provide primary schooling to children has now been diverted to COVID-19 relief efforts. So there is increased unemployment, there is a decline in industrial growth. Large corporations have definitely survived, but the small businesses struggled the most. And there is also the concern of environmental sustainability. There is more use of packing material due to increased e-commerce, and there is more nuclear travel after COVID-19. Even though there have been some benefits as well, like I am joining today from Pakistan. A lot of mobility has also increased. There are some benefits as well of connectivity, but there is also this concern that the resources are not being fully utilized in the post COVID-19 era. And law and order deterioration has also happened in regions where there is increased poverty, increased unemployment, and where the governments are not able to stabilize the situation in an effective manner. So these are some of the socio-economic challenges that we are facing in the COVID-19 era and in the post-COVID-19 era. Now, if we look at the challenges to Islamic banks in particular in the next slide, we will see that Islamic banks are also facing a lot of challenges in this COVID-19 era. For instance, when we talk about the different kinds of product structures in Islamic modes of financing, the major mode of financing for short-term borrowing or short-term financing is Murabaha Mu'ajjal. Now, in Murabaha Mu'ajjal, once the price is agreed, it cannot be changed. Now, if in COVID-19 era or if in post-COVID-19 era, if a business is struggling, if a person is struggling to pay the price of Murabaha Mu'ajjal and is not able to pay on time, now Islamic banks cannot reprice, cannot increase the price just because of delay in payment. And even if they charge any penalty for late payment, it won't go to the profits or incomes of the Islamic bank, because they cannot charge any benefit on late payment for themselves as income. So repricing is an issue in Murabaha Mu'ajjal, and delay in payments are very common in post COVID-19 scenario. A lot of businesses and individuals are struggling to pay their financial liabilities on time. Conventional banks are able to reschedule loans more flexibly, because for them, it does not make a difference whether something is riba or not. But in Islamic banking, we have to see that whether something is allowed or not. So repricing in Murabaha Mu'ajjal is a challenge in Islamic banking. And then there is a rate of return risk in fixed rate contracts. So what has happened is that if, let's say, in pre-COVID-19 era, there was an agreement made between an Islamic bank and the client, and it was a medium term to long term financing contract, and the rate of return was fixed. So now in the post COVID-19 era, what we are seeing is that due to high inflation, many central banks are keeping the interest rate very high. So if the interest rates in the current times have increased a lot, but still when the contract was done between Islamic bank and the client, at that time the interest rates were very low. So if this happens, then there is a rate of return risk in fixed rate contracts faced by Islamic banks. And then when it comes to distress financing is that when you are looking for finance not to expand, but to pay your current liabilities, your past liabilities. So if a business is struggling to pay for its liabilities, then it is not looking to expand and buy assets. So when it is not looking to buy assets for expansion, Islamic banks have limited solutions for distress financing. Yes, there are some solutions which we are going to talk about in the next slide, but not all modes of financing are suitable for distress financing. And there are also limited solutions for working capital finance, especially for liquid funds. So when it comes to buying asset, Islamic banks have different kinds of contracts which they can use to provide financing for purchase of assets. But when financing is required for other purposes, not just to buy an asset, then the the product solutions are relatively little bit limited as compared to when clients are looking to buy assets. There is also increase in defaults, even though it's not reaching a very alarming rate, but still there is increase in non-performing loans to total financing ratio in a post-COVID-19 situation as compared to what it was before. And then there is also a challenge of not having the ability to roll over loans like the conventional banks. So conventional banks feel happy if there is a rollover of loan, because they do not have to make new efforts or incur additional expense of finding a new client, but they can simply just continue the loan, reschedule it, and they would save this cost of finding a new client or administering the loan. But Islamic banks cannot do that. Every financing transaction in Islamic banking is a unique transaction. So it cannot be rolled over, it cannot be combined with another transaction. So this creates little bit problem when it comes to clients not able to make payments on time. And also when it comes to opportunity cost compensation in Islamic finance, opportunity cost is not recognized as a worthy concept of compensation. So simply because you uh, incur an opportunity cost but no explicit cost, there is going to be no compensation for it in the financing contracts once the liability is created. So once the Murabaha transaction is executed, even if let's say the client is not able to make payment on time, Islamic bank cannot charge additional amount and take it as its income. So there is no concept of opportunity cost compensation. So Islamic banks have to be little bit more careful in their risk management as compared to conventional banks who can simply roll over the loans and who can reprice the loans at any time. So these are some of the challenges which Islamic banks are facing in the post-COVID-19 era. So moving forward, uh, in the next slide, we are going to look at what is the response to the challenges by Islamic banks. So what are the different solutions which Islamic banks have? They have different solutions for working capital finance, for instance, Salam and Istisna. So these are the contracts where Islamic bank would not act as the seller of good, but for the client, it would act as the buyer of good. And when it is acting as buyer of the good, when it is purchasing the goods, it will pay the price to the client to purchase the assets from the client. And when the client gets the price of Salam asset, when the client gets the price of Istisna asset, it gets the liquidity which it needs to basically manage its working capital finance. So in Murabaha, Ijara, Diminution Musharaka, and other contracts, what is happening is that Islamic bank is entering into a asset financing contract where Islamic bank would sell some asset to the client. So client would get the asset but not the money, not the liquid money, which it can use to manage its working capital finance. But in Salam and Istisna, basically client is the seller and Islamic bank is the buyer. And when Islamic bank buys the asset, especially in Salam contract, it pays the price upfront 100%. So when client gets all the price upfront from the Islamic bank in Salam contract, it gets the liquidity which it needs to basically manage its working capital finance. So we cannot say that Islamic banks have zero solutions for working capital finance. Yes, not all modes of financing are suited for that, but there are at least two contracts, Salam and Istisna, which can be used for working capital finance. And then when it comes to distress financing, Islamic banks have different options like Salam contract and also sale and leaseback contract. Sale and leaseback contract simply means that if let's say client has a asset, what it can do is that it can sell the asset to the Islamic bank and can lease back the asset from the Islamic bank. So it would be able to, the client will be able to use the asset like it was using it previously. Only difference will be that it has restructured its balance sheet. it has sold an asset and got it on lease. So it will continue to use the asset, but it will be able to generate more liquidity, so that the liquidity problems, the distress financing problem can be solved. So sale and leaseback is very common, especially in the Ijara Sukuk structure as well. Salam and Istisna are also possible for distress financing. And then Islamic banks also have this feature that almost all their contracts are asset backed. So when it is asset backed, what happens is that asset prices would really matter when it comes to what is the value of the financing contract. If there is quick recovery in price of assets like real estate and commodities, then Islamic banks are not at a disadvantage. So for instance, if Islamic bank has provided real estate financing through diminishing musharaka or through ijara, now if the real estate price is increasing, even if let's say the client is not able to make payments on time and wants to get out of the contract, still the asset can be sold. And if the prices are higher than previous periods, then what can happen is that Islamic bank can recover its investment in the asset more easily when the asset prices are increasing. And then there is also this feature in Islamic banking that when it comes to asset liability management, there is a clear pass through of returns without legal risk of need for matching returns. So at least there is no legal requirement on Islamic banks to pay a positive uh, rate of return to the depositors. There is no legal requirement, because when they are mobilizing the deposits for investment, they are mobilizing on the basis of mudaraba, where there is no guaranteed return committed to the depositors. So if let's say there is a low profit earned by Islamic bank, uh, there is no legal compulsion to pay higher return to the depositors, unlike the case in conventional banking. Yes, practically speaking, Islamic banks, as small players in the market with a small market share, face the commercial displacement risk. But commercial displacement risk is not legal risk. It's not that you are legally bound to match the returns which is paid by the conventional banks. You can still uh, pay the actual return that you have earned, and it could be different than conventional, it could be more than conventional, it could be less than conventional, but there is no legal requirement as such to match the returns. And what we see in many countries is that Islamic banking deposit rates sometimes are lower than the conventional banking deposit rates. So there is no legal compulsion on Islamic banks to always match the conventional banking rates. So this becomes a little bit of an advantage for Islamic banks, that they are not legally bound to provide a committed positive rate of return, uh, unlike the case in conventional banking. There is also relatively less non-performing loans in Islamic banks as compared to conventional banking, and also the asset quality in terms of having more proportion of secured financing in the financing mix is higher in Islamic banking as compared to conventional banking. It is because Islamic banking mostly uses asset-backed financing. So in asset-backed financing, there is an automatic feature of secured financing, because Islamic bank has recourse to the asset when it comes to delay in payments or defaults from the client. There is an asset which Islamic banks can liquidate to recover their investment. So asset quality and the risk is in a much better situation in Islamic banking as compared to conventional banking. And we are also going to see the empirical evidence, which also basically confirms that. So moving forward, in the next slide, we are going to discuss what is the value addition in response via Islamic social finance and fintech. So what we are seeing in the post-COVID-19 era is that Islamic banks are also evolving. They are also embracing technology. They are also aware of the fact that there is a higher disruption risk that they are facing because of a lot of alternate platforms for payments, for transactions, which are coming into the financial ecosystem. So they know that for payments and for remittances and for funds transfer and for e-commerce, banking is not now the sole medium. There are also alternate payment platforms. There are also alternate remittance platforms, which are also providing the same service, and they are also competing with banks for this business. So Islamic banks are aware of that, and that is why they are also embracing technology. They are also offering a lot of digital financial services. So one good thing that has happened in the post COVID-19 era is that Islamic banks have ventured into the fintech arena, in digital banking arena. In a lot of countries, full-fledged digital banks are being established, and that is also a very good development in post-COVID-19 era. And also what we are seeing is that Islamic social finance is able to show its true promise in the COVID-19 era, uh, where we saw that markets were closed, unemployment was increasing, poverty was increasing, people were not able to afford goods and services, afford even the basic necessities. And that is when Islamic social finance showed its true potential. A lot of funds were mobilized through charities and through crowdfunding, through zakat and through cash wakaf. And all of that showed that even if the markets are not performing well, Islamic social finance can do the redistribution of resources beyond the market. So this is one very important source of redistribution in Islamic economics and in Islamic social finance, that it does not depend on the market forces. It does not depend on the business cycle. Even if, let's say, there is a recession or a depression, even if, let's say, there is economic downturn, still Islamic social finance can contribute to provide the redistribution of resources from the haves to the have-nots through the institution of zakat, through the institution of cash wakaf, through the institution of sadaqah. And we saw a lot of that happening in Muslim majority countries. And that is why they were able to fight COVID-19 related challenges in a more effective way as compared to some of the other countries. Even though in some of the Muslim majority countries, the governments are very weakly funded, they do not have enough fiscal space and tax revenues to basically uh, buy all the medicines and the vaccines. But still, through crowdfunding and through Islamic social finance, a lot of the problems were solved at the community level, at the private sector level, even without the help of government and international donor community. And there is also increased digital financial inclusion that we are seeing after the COVID-19. So much more proportion of the population now has banking accounts and now is doing e-commerce as compared to the pre-COVID-19 era. And Islamic banks are embracing all this change. They are able to build their capacity, technological capacity, and also risk management capacity to enable financial inclusion in the digital space, and also have a strong presence in the digital space. So there is growth in fintech. We are seeing a lot of Islamic fintech companies in insurance and also in asset management, wealth management, advisory services, remittances, and also payments. So all of this is very good development. And we are also seeing some unique structures. Like Indonesia is a pioneer and is a leader in coming up with innovative solutions in the Islamic social finance and Islamic commercial finance. It has combined the Islamic social finance instrument with a commercial finance instrument, which is Sukuk. So Waqf-linked Sukuk have been launched in Indonesia as well. So we have seen that in the post-COVID-19 era, Islamic finance is able to cope up with the challenges with innovative product solutions, with a broad mix of Islamic social finance and Islamic commercial finance solutions that it has. And that is why it is not able to, having this problem of low growth or irrelevance in the post-COVID-19 era, Islamic finance is still relevant. Islamic finance is still having a very good growth trajectory, even though when it comes to Sukuk, definitely it depends on market situation, it depends on economic conditions. There is a little bit decline in the growth in the COVID-19 era in the Sukuk issuance, but it's not that Islamic finance has faced a major uh, blow after the COVID-19 breakout. So
Excuse
moving
me,
forward,
Dr. Salman,
yes,
could you please be faster? We
yes,
have
yes,
3 more minutes, I think.
yes,
Thank you.
inshallah, I will try to summarize. Can you move to the next slide? Yes. So when we look at the economic recovery in the post-COVID-19 situation, what we saw was that there was economic recovery in 2020, but when uh, the Russia-Ukraine uh, war broke out, we saw that this economic recovery was very fragile. It was very short-lived. Now what we are seeing is that there is high inflation leading to high interest rates which are kept by central banks, and which is increasing the cost of finance for the businesses. And when the cost of finance is very high, definitely there will be less demand for loanable funds in the market, and banks as well as capital markets would not really thrive and flourish in a scenario where the cost of finance is very high. So this is one challenge that is being faced. And also governments are also facing liquidity problems. So definitely there is a case for having more Sukuk issuance, but still Sukuk is a commercial finance instrument. So there is a price to be paid for it as well. So even though governments are needing finance, and it makes a case for more Sukuk issuance in the sovereign Sukuk market, but governments also need to see that do they have enough liquidity to service and to afford those Sukuk issuances. If we look at the world economic outlook, it presents a bearish outlook for 2023 and beyond. And these are the challenges which Islamic banks still have to cope up. And then there are natural disasters being faced in some of the countries like Indonesia, like Pakistan, and also Turkey and Syria. So these natural disasters and the socio-political situation in some regions like Russia-Ukraine conflict. So all of these are creating problems and creating hurdles in international trade, and it also affects Islamic banking because trade finance and the trade related activities are very important for Islamic banking because they deal in assets, they deal in real economic transactions. So moving forward, in the next slide, we are going to look at the evidence of resilience in Islamic banking. So if we look at the capital adequacy ratio, which is the CAR ratio or gross non-performing financing ratio, or the profitability ratios like return on asset and return on equity, net profit margin, and efficiency ratios or indicators like cost to income, what we see is that in most of the countries, Islamic banks are actually performing really well. And this data is updated till 2022. So what we are seeing is that Islamic banks are adequately capitalized, and they are maintaining the Basel requirements very easily. And then when it comes to asset quality, the gross non-performing financing ratio is not very high in most of the countries, except in Bahrain, where it is slightly above 10%. When it comes to return on asset and return on equity, in almost every country, the return on asset and return on equity is positive, except in one country, Morocco. And when it comes to net profit margin, still we see a very good situation for Islamic banks in most of the countries. When it comes to efficiency indicator, which is cost to income, what we are seeing is that Islamic banks are able to go into the digital space and also expand and get the economies of scale advantages, and they are becoming more efficient as time passes. So last slide, which I will like to show, is about the Islamic capital markets, how Islamic capital markets are doing before COVID-19 and after COVID-19. So the next slide shows how Islamic capital markets are performing in the post-COVID-19 scenario as compared to the scenario before. So what we are seeing is that in many of the regions and in many of the asset classes, Islamic capital markets are showing resilience. And this is confirmed by earlier evidence as well, which says that and which suggests that Islamic capital market instruments are performing well in scenarios where the economy or the market is not performing really well. So in bearish market, in recessionary periods, Islamic investments provide a good solution to manage risk and to provide stable returns. So this is also confirmed by the evidence which we can see in this slide. In stable income investments, in equity investments, and in almost all regions, Islamic investments have performed better than the conventional instruments. So all of this shows that Islamic capital markets are resilient, even though they have also suffered a setback when COVID-19 broke out, but the recovery was very fast. And the recovery was very swift, and it just took a few months to recover. And this was a case which was exhibited in almost every country. Every country's capital market in Muslim majority countries especially recovered within few months. So Islamic capital markets are buoyant, they are resilient, and they are providing positive returns in the post-COVID-19 scenario. But the challenges which are now being faced of high cost of finance and low economic activity, they would still pose challenges to Islamic capital markets to continue this stable growth path. So I will end my presentation here. If there are any question and answers, I would be happy to answer. Terima kasih.
Okay, thank you. Let's give round of applause to Dr. Salman.